Good morning, everyone, and welcome to day 2 of our workshop with FinTech Alliance. So yesterday you heard from John. We talked about putting your best foot forward. Today we're going to talk about types of funding and engaging with investors, and also we'll explore a little bit about how VCs work. And tomorrow we're going to be talking about term sheets and closing the deal. So John covered yesterday the financial model. He talked about the way to present a pitch deck and the data room. We were then joined by Sam from Quantico, who talked about the inputs and outputs of a financial model. And then lastly, Devon then joined for a panel, a partner of Cell Capital, talking a bit about what they look for when they look to make investments. The agenda for today, I'll be going through the investment process, discussing the types of funding available to you as entrepreneurs, and also touching on how to put yourself in the shoes of the investors, to build empathy and to build a better relationship with them. And then after that, we're going to have Nick from Octopus Ventures join us, who looks after their fintech investments, as well as Richard Haynes from Bright Light, who have just closed a Series A. Tomorrow, we're going to do a deep dive into the detail behind term sheets. I know this is a topic that's often misunderstood by some founders, and often it's difficult to actually negotiate and understand what those terms mean. And we'll be trying to explain them in plain English, the key terms throughout a typical term sheet. We're then going to be joined by Anthony, the CEO at Seed Legals. I think they probably see the most amount of deals in the UK at seed, early seed, and early Series A stage. And so Anthony will be sharing some tips and ideas on some of the data that he's seen. And then after that, we're going to have a panel with Alex, who is another partner at Mountainside Ventures, Anthony and Olivia from FinTech Alliance. So I've got 2 slides, which you'll have seen yesterday for the ones that joined. A little bit about what we do. So our mission is to help the most ambitious entrepreneurs raise the next round of funding. And we do that in 3 different ways. We get you guys investor ready. We then introduce to the relevant investors, and then we help you close the deal. And what we try to do is take these 3 different areas and try to condense them in an hour and a half to give you as much insight as we can over the next 3 days. And the result of that, hopefully, is a cut in timeline for fundraising, and also a more time spent for founders and CEOs on their business rather than becoming professional fundraisers. So the program I just talked about, the Next Round program, is where we support startups, and that's a program principally for early stage companies. However, as you may have heard from yesterday from John, we also work with investors, VC funds, and also their own investors called limited partners. And I'll touch upon a little bit what that means later on in the session. But the reason why this is super relevant to you guys is the investors that often invest in VC funds, who are family offices, are also interested in investing directly into companies. And so we're building up a really good network of family offices who may be interested in investing in entrepreneurs as well as into funds directly. And the second reason is by working with those VC funds who are currently raising, introducing them to their own investors, supporting them through our various initiatives, actually that puts us in a position where we can really understand who's investing and when. And this is really critical because if a fund has capital to deploy, they're active. If they're fundraising, they're not active. And so by supporting them on their own fundraise, we can understand when they're running and fundraising for their own fund and when they're actually deploying capital. And that puts us in a good position to introduce you as entrepreneurs to the relevant investors. The 2 initiatives that we do at that level, the first one's called Capital Behind Venture. It's a survey that looks at family offices and limited partners interested in investing in funds, and we're doing that with a whole bunch of different partners, including the BVCA, the British Venture Capital Association, and also Deal Room and a whole bunch of other partners. And we're producing a report on the venture ecosystem, which will be published in a couple of months. On the funding venture side, we organise conferences, dinners, and make introductions to those investors. The team, so John introduced himself yesterday. My name's Jonathan Hollis. I'm the management partner at Mountainside Ventures. Together as a team, we built PwC's early stage propositions, so the scale and the raise programs, which helped over 400 companies, predominantly B2B with some B2C companies, connect to their big corporate clients and also supporting them through their fundraise. Prior to that, I spent some time in audit as an accountant and spent a bit of time in their deal practice. And before that, founded my own edtech startup. So we'll get straight to it and discuss the types of funding available for entrepreneurs. And they fall into a number of different buckets. We're going to talk through each of these in turn and give you some understanding of what they mean, the source of finance, and also a bit about their investment criteria, how you can reach them, and we'll touch upon COVID implications. So whether they're more or less likely to be active in the current environment. So we'll start with family offices and high net worth individuals. So the money from angels and from high net worth typically comes from themselves. It comes from them either being rich because their parents were rich, or simply being wealthy because they might have exited a business themselves. And those two types of family offices, your kind of first generation, second generation, dictates a little bit the appetite for investing in entrepreneurs. If you can imagine someone who's built a business, made a fortune, exited, they're more likely to then give back to the community and engage and invest. Whereas your second and third generation family offices treat capital more as an asset allocation mechanism. So they've got a pool of money from their parents, from their grandparents, and they're looking to invest that money. And it may be entrepreneurs, maybe startups, or it simply may be the listed markets, the public markets, and other companies. As John talked about yesterday, the investment criteria is a step down from the institutional. Typically, they're looking, they can look at you in the eye and decide whether you're a backable business. The check size is typically a little bit smaller. The diligence is easier to deal with, and the process is generally easier. There has been a small shift for some multi-family offices. So multi-family offices is effectively when a wealthy family has a number of investments and they decide, from an active perspective, to actually create a vehicle to invest. And the multi aspect simply means that a group of family offices are investing in a vehicle. And what we find recently is that those multi-family offices with investment vehicles operate much more like VCs than single family offices or first generation family offices. So even within this sector, there's a number of different buckets and a number of different strategies and criteria. COVID implications on this, it completely depends on the individuals. It probably depends on their generation. It depends on the number of portfolio companies they've invested in. But generally, they're probably less active than they once were. Angel syndicates are very active in the UK, and they represent a big group. I've put a couple of examples of syndicates who have made recent investments, but typically the money here comes from a group of angels. So instead of one angel coming in and investing in a company, organizations, some tax efficient, some not, and I'll come to those in a minute, will group up together as a network. And often angel syndicates are popular where if an angel wants to invest 5, 10, 20,000 pounds into the business and a company's raising a couple £100,000, then it doesn't really make sense for all those negotiations to happen simultaneously within the founders. And actually a group of angels is a much more efficient vehicle to invest. The criteria is very similar to the angel criteria, and often there's organizations that have built a network of angels and actually that then take your business and introduce them to those angels. If you take an example such as Coutts, the bank, they've got a whole bunch of high net worth individuals. They have a network whereby for some organizations, for some startups, they take the companies and they introduce them to their ultra high net worth clients. So venture capital is the one that's most common. The biggest difference, as John touched on yesterday, is that these guys, it's not their capital, it's not their money. They are the holder of someone else's money, and they are simply asset allocators. Although it's a very sexy term, and a lot of people are interested in receiving money from venture capital firms, the reason why John went through those documents yesterday on the 5-year financial model, on the pitch deck, on the data room, on the cap table, is because these guys are holding money and investing on behalf of someone else. And therefore, there's a whole bunch of legal implications when you do that. They've got to prove to their investors they're making the right decision. They've got to ensure that there's sufficient returns, and I'll touch upon the fund returns later on today. But all of these discussions and a little bit of this presentation and yesterday's presentation is dictated upon the fact that these guys are investing someone else's money. And we put a couple of examples of what they typically look for, repeatable business metrics, recurring revenue, the good founding team, a big market, and really high potential exit returns. EIS and VCT funds are the next one. Arguably, these are the reason. These two, I guess, tax efficient schemes is probably the single biggest reason the UK is where it is. They started 20 years ago, and they produce really, really good tax efficient schemes for high net worth and angel investors. And this is the reason why the UK is at the centre of the ecosystem across Europe for venture. And you can see here, 30,000 companies have been invested in through EIS, which is absolutely insane over the kind of 25-year period. We've put a couple of comments here on the slide as to the criteria for EIS and VCTs. There's a number of criteria that you need to hit to ensure that you're compliant. Many of you on the call may be going through your advanced assurance, and I've got a separate slide on to talk about that. And if you'd like some more information on EIS and VCT, there's a bunch of knowledge online, and please get in touch and we can point you to the right direction. So the money for these organizations come from retail investors, which is a fancy name of just simply saying angels and healthy, wealthy individuals. Typically, organizations that are raising EIS and VCT funds, the typical check size of an individual is anything from £20,000 to £25,000. So if I was an angel investor and I had a couple £100,000 a year salary, I would invest in some of these vehicles. I would then claim back as part of my income tax liability and offset my investment into these organizations. So it makes it a really interesting vehicle as an angel investor. The process for raising money, when you're working with these individuals, it's not their money, but they haven't raised money from the big institutions. They've raised money specifically from these retail investors. And typically the way these organizations are structured is they're structured into two different teams, which is very different to how a VC is structured. The EIS and VCT funds are structured. There's one team that does the sales and marketing. There's one team that goes out to market and says, we've got a fantastic team that sources the best companies, and they ask for money from these retail investors, either through agents or directly with their network. Then there's a separate team that does the actual investing. And there's a bit of a disconnect between the two, but that's simply because the job description is very different. The investment criteria for these organizations is very much standardized. If you're raising a seed or if you're raising a Series A, there's very clear revenue metrics that often they publish on their own websites. And later on, we'll be publishing a list of those who are still active. The implications during COVID are that the way the firms are structured is the investment typically happens, the majority of investments typically happen near the tax year end. That's because a lot of these retail investors and angel investors actually benefit from these things just before the tax year end occurs, so they can reclaim some of their tax liability. And so typically, therefore, the activity tends to be kind of Jan to March period. And so clearly the implications there is if the activity is Jan to March, it's likely that they'll probably see a decrease in value in deal volume and deal value over the coming few months. And this is a quick note on some things to think about when you're applying for advanced assurance. I suspect many of you on the webinar know about this already, but you can find a whole bunch of stuff online specifically about this. And bear in mind that it can take some time for HMRC to actually approve your application. Corporate venture capital is an interesting beast. So I guess the key analysis of where the money comes from here is obviously the corporate. And this is an organization that makes money from selling its products and services, and then siphons off some of that capital to invest in early stage companies. Two reasons why they might do that. Firstly, there might be a strategic angle. They might want to leverage some of the technology that's being used and leverage some of the investments they're looking to make. So, for example, if there's a great deep tech company there that they're looking to potentially, that might support them by, I don't know, reducing their costs or increasing their customer experience, they might look to invest in that company to take advantage of that technology. That's reason number one. Reason number two is more of a competitive angle. So if you're a big bank and you're worried about Monzo, you're worried about Revolut, you're worried about some of these challenger banks taking all of their business away in maybe 10 years, the market, the valuation of that company might be 10 times the valuation of your bank, as an example. You might want to take a stake in that competitor to ensure that you benefit from their increase in value. So those are typically the two reasons, to kind of cover themselves for a fall in value in the future, or simply as a strategic angle. The criteria varies across different CVCs. Some of them have got a very separate outsourced team. Others have got an in-house team. And the way that you present your business is quite different to those two organizations. Typically, the ones who have got more in-house team are going to be more internally focused. The ones who have an outsourced team are going to be more externally focused and operate a bit more like a VC. So they'll be looking at the financial returns as well as the strategic angle of the VC. Recently, we found a number of those kind of investors have also actually siphoned off into their own organization, their own fund, looking to raise their own capital. And so the corporate will be one of their biggest investors. They're also looking for other family offices and other corporates to join. And those operate much like a VC rather than like a CVC. COVID implications, at a very high level, these organizations take 6 to 9 months to make a decision. There's a long sales process, much like when you're looking to sell into these organizations. For the B2B companies on the webinar, I'm sure this is something you're used to, these long sales cycles. Just imagine the same thing, but with an investment lens, with a lot more risk, a lot more compliance, and a lot more controls in place. So you can see that the obvious implication for COVID is that they're just taking more time, and therefore the investment process timeline has been extended. A couple of examples of CVCs that have made recent investments on the screen for you. Next one is government support. The government has done a lot for startups in the last 6 months, and has a whole bunch of initiatives that have always been in place, like the tax efficient schemes I talked about, like the R&D, like grants, and all of these different initiatives. Generally, the UK government, compared to other governments, are super supportive. And this is another reason why we're in the position where we are. France, President Macron, as an example, is looking to follow much of the initiatives that the UK government have started. A couple of initiatives, I think most of you guys will probably know these already. The Future Fund criteria has been extended recently to apply to non-UK companies with a non-UK headquartered, if they've gone through an accelerator which have essentially asked them to incorporate a non-UK topco. So there were a bunch of complaints with some of the companies have gone through Techstars and Y Combinator that actually they were UK based, but they were asked to incorporate overseas. And now this change it means that those companies are now included. There's grants, there's loans, the interruption loans, the bounce back loans are interesting, but that they're still loans. And so if you're looking for free money, that 5K is the only option. And of course, the Future Fund has been successful in the sense that it was massively oversubscribed, and the government are publishing regularly every week figures on specifically the amounts of investments that they're looking to put into. And currently, there's a number of organisations that are lobbying the government to better understand which companies were eligible and which companies received that funding. It's worth noting, and this is again something that you might be aware of, that the Future Fund does not reconcile with the EIS and VCT tax efficient schemes, which upset a lot of investors. I.e., if you've already got a tax efficient benefit within your equity table, cap table from a VCT or EIS perspective, you cannot then benefit further from the government support. Which, and presumably in their mind, made sense because you've already got some support, but in the minds of the early stage seed funds was a big problem. Venture debt is much more relevant for companies that are EBITDA positive, i.e. venture debt is effectively a loan, a bank loan that organizations are now typically providing to early stage companies who have also got an institutional investor involved. If you imagine the reason why the VC industry was created was to support these high risk, high return businesses. The offset, of course, is they take equity in your business. So if they invest in a company and a whole bunch of companies fails, at least they'll benefit from the upside. Venture debt, typically, unless they've got warrants, and some of them do, cannot do that. If they invest and if they lend £1 million into a company and they take 6 to 10% interest and half of their companies fail, they're going to end up with massive losses, which is why venture debt is typically more geared, A, if you've already raised institutional funding, because then they can rely on all the diligence that maybe a mid to top tier VC have already done, or B, if you're EBITDA positive, i.e. if you can afford to pay the interest rate that they charge on a consistent basis and you've got recurring revenue and you've got more money coming into the business than going out, it's clear this will be more relevant to you. So if you don't hit either of those criteria, it's probably not something to spend too much time on. These are a couple of venture debts that have made investments. In terms of COVID implications, I don't think they've been very hard hit. If you hit the criteria, if you've got some revenue, if you're cash positive, if you're growing quickly, and if you've got an equity institutional on board, this is a really good route to go through. Why? Because you're not giving any equity away. There's a bunch of alternative financing options. The advanced subscription agreements are becoming more popular, as are the convertible loan notes. At a very high level, ASAs effectively is a promise for equity in the future, and you get some cash up front, whereas a convertible loan note is a loan up front with a promise to turn into equity in the future at the next funding round. Typically, there's a discount of 20 to 30% on those convertible loan notes. The reason being behind the discount, well, if I'm an angel and I'm investing £1 million into your business and you're raising at 2 or 3 mil at a 10 mil valuation, maybe in a year or two's time, and I'm prepared to invest £1 million now, clearly I'm taking some risk. I'm taking some risk by being a first mover and by investing in you now rather than waiting for your big formal institutional round. And therefore, I get compensated for that risk. It's a bit, you can probably think of it as 2 different rounds, but the benefit for entrepreneurs is they don't have to set a valuation, which is great, because if you're a pre-revenue company, or if you're on maybe 100K a year and you're looking for a 5 mil valuation, which is a ridiculous revenue multiple, you might choose to do this because you back yourself in the next 6 months to triple, quadruple your revenue, and therefore be in a much stronger position to then raise your institutional round. Lastly, revenue-based financing. This is something that we wrote an article about recently, last week, and you can find it on our website. If you Google Mountainside Ventures, we've got a resource page, and we've got some notes on this area. It's becoming super popular recently, and actually, if you're a company that doesn't quite qualify for VC funding, i.e., you're not doubling in growth, your revenue you haven't hit your magical 1 million revenue run rate. If you're looking for a Series A, this is a really good alternative. Typically, the criteria are you need to be a software business. For the ones based in the UK, you need to be UK based. And then the third criteria is you typically need to have £10,000 a month revenue. And that's to be on a recurring basis. And what the revenue based financing organizations do is they lend based on revenue. And the benefit is it's a lot more flexible. You know straight away what the answer will be. And of course, if your revenue falls, your loan payback falls. If your revenue increases, the amount you pay back increases. So it's super flexible. We did an article with Uncapped. If you're interested in an organisation in the UK that currently provides those loans. So who's investing? So a couple of factors to think about on who's investing from a investor's perspective on who's open for business. So VCs, or maybe EIS and VCT funds who've recently closed their fund, are more likely to be investing. Those who have made investments are more likely to be investing. Data doesn't lie. Closed funds don't lie, regardless of whether they all say that they're open for business. Existing portfolio companies, if they're at risk, it's unlikely that the investor will be super open because they're running around trying to sort out their portfolio companies. This was relevant maybe a month ago. It probably still is now, but we're seeing an increase in appetite in investments as funds are starting to make deals remotely. And actually, we're going to be joined by Nick in about half an hour to talk about. Actually, I'm going to ask him about a recent investment that he's made, because they've just closed an investment remote only from a company they'd never met in person. So he'll share a bit of details as to how they managed to do that. Companies and VCs who are open to business, so if they're at the end of their cycle, they can, they can probably afford to sit on their hands. Just put yourself in their position. If you've got your portfolio at risk, it's unlikely that you're looking to make new investments. And also one factor that is very hard to understand and to diligence is the LPs themselves. So remember, those are the investors in their own funds. There were a couple of cases where the limited partners, there was one hotel chain, as an example, a couple of months ago, they just did not have the capital to provide to the VC who wanted to invest in the startup. And so that's another factor to consider, maybe a question to ask, how are you, if you're speaking to a VC, how are your LPs doing during COVID? As soon as you ask that question, the VC will they'll be surprised that A, you know anything about their LPs, and B, that you're interested. And actually, they'll probably provide you some really useful insights that you can then use and understand, perhaps as a value add, who the LPs are. Often they like to make co-investment opportunities, but also just a great way of building that relationship with those investors, because that's their biggest pain point. So a list here on VCs that have raised their fund in 2020. I think this is also the ones that have done it in the last 2 months. I updated this yesterday evening. If you need a copy of this, again, if you Google Mountside Ventures and go on our resource page, there's a section on 150 VCs still deploying. This list is on there. Alternatively, you can email me at Jonathan@Mountside Ventures, and I can ping you the Google Doc. So these are the ones that have raised funds recently, and therefore, just by definition, are looking to be active. The way to consider this, and again, there's another 100 or so on the Google sheet, is to look at the total fund size. So if a company is raising, as an example, let's look at C4 Ventures. C4 Ventures have raised, I think they've done a first close last week, and they're looking for an additional, I can't remember how much, but over the next couple of months. So C4 have got an 80 mil fund. Typically, VCs save 50% of that fund for follow-on investing. So that means that out of the 80 million fund, 40 million will be siphoned off for later stage follow-ons. So really, you're looking at 40 million to be applied into companies for the first time. Typically, you're looking at 10 to 15 companies. So within a 40 million, therefore, you can see, just basic maths, they're probably going to invest between 3 to 4. Maybe their investment thesis is 1 to 5, with a sweet spot 3 to 4. So when you're looking at the typical fund size and you're trying to understand the typical sweet spot for a fund, the economics have to work. If they invest in 10 to 15 companies and they reserve 50% follow-on, it's a very simple exercise to figure out what their sweet spot is. And these are funds that have recently made capital, so recently deployed. Fuel have been doing a load recently on currently Local Glow have been announcing quite a lot. Octopus, obviously, Nick, we've got later on to talk about their investment criteria. So companies are still active, and the best way of understanding which ones are active is simply by looking at the data. And again, this is also a list shared on our on the document. So we'll turn into putting yourself in their shoes and understanding how VCs work, which is perhaps one of the lesser known topic areas amongst major entrepreneurs, unless they've got prior experience in the investment world. So this diagram shows how the whole ecosystem operates. At the very top, you've got the limited partners. These are organizations such as corporates, endowments, family offices, government. You'll be very surprised to hear that 30%, I think, across Europe is government funded. 30% of the money you guys raise comes from taxpayers' money. It's pretty insane if you think about it. And really, you don't really know where the money comes from when you're pitching to a VC, but that's the number. The EIF in Europe and the British Business Bank in the UK, they are tax funded. So your limited partners are the investors that invest in VC funds. They come in all shapes and sizes. If you think fundraising is hard for a startup, these guys take 2 to 3 years to raise a fund. It's bloody difficult. They've got a really difficult job, and the one of the missions that we do at Outside is actually, can we make this section more open and more transparent? As entrepreneurs, you can go on a website, you can go on Notion Capital, and Notion will tell you we invest in B2B at Series A, Series B. We look for whatever million revenue it is. If you're going on an LP website, typically you're not going to find that information. So your limited partner provides capital. They invest in a venture fund, and in return, they get returns. And those returns are in the form of a management fee, typically of 1 to 2%, and carried interest, which effectively means a slice of the profit of 20%. So a typical VC fund who's raising £100 million, they will get £2 million of operational fee, which makes sense if they're a team of 15, and a couple of partners will be on 150k. There'll be a bunch of associates, maybe 50 to 80. There'll be their rent, there'll be all of their marketing expenses, and so they've got £2 million per year, which typically falls as you get closer to the end of the fund, but £2 million per year to invest. So what that means is, often if you're working with a company which is a 20 million fund, you can see that they're not going to have much money at all. 400k isn't much. It's not. A lot of these organisations are living on a shoestring, and when you're asking investors for capital, and if some of them charge you fees, it's because they're not operating with much cash themselves. This isn't, of course, the case for the top tier VCs. Tomico, who raised 750 million a couple of months ago, you can do the maths. 2% of that is a fairly meaty amount for those partners. Then the carried interest is the profit share that they get on investment. So you as entrepreneurs, when you decide to, hopefully you'll exit for 10, 20 times return, the investor above a certain hurdle rate, and I'll talk about that in a sec, will then take 20% of that upside. So you've got to put yourself in their shoes. If you're speaking to a partner, and a partner in a VC fund is looking to give you £2 million, you've got to persuade him or her that by parting their cash in your business, you're going to become their next unicorn, and therefore they're going to get in their personal bank account 20%, which if you think about the maths, probably 5% to 2 or 3 of the partners and 5% for all the associates, maybe 0.5% each if they're lucky. So they're going to be sitting with 5% of that total increase in the value of the fund. It's a pretty big incentive, and that's why some of them, that's why they go through the process they do. Then the bottom, you've got the startups, you've got the portfolio of entrepreneurs who are raising money, and the difference between, as entrepreneurs, you don't see the top level, you don't see the middle level. You might see the top level for a number of reasons. A lot of limited partners, especially family offices, love co-investment opportunities. They really like to invest, and the reason they like co-investment opportunities, you can probably figure out from the maths. If I'm a limited partner and I'm giving £20 million into a fund, I'm paying 2% management fee on that £20 million. However, if I can argue and negotiate co-investment rights in their equivalent of the term sheet, the LPA, I can then not pay the 2% management fee and get access to their companies. So a unique selling point when a VC's fundraising is the benefit of introducing their LPs. And so when you're speaking to VCs, definitely ask them about their LPs. Who are your investors? Remember, this isn't relevant for the EIS and VCT funds, because those guys are investing from angels, typically £15,000 to £20,000. This is relevant for the mid to top tier VCs, which make up probably 30 to 40% of the total venture ecosystem in the UK for seed to Series A. The rest being the tax efficient schemes. So the VCs then invest in the startups, and they negotiate terms for you. So just a couple of things to think about when you negotiate in terms of the term sheet. This is the structure, and those are the incentives. So build empathy, be aware of these things, and it will put you in a really good position, a really strong position when you're talking to investors. The way the fund cycle looks like, you've got these it's a very simple diagram to just give you a bit more explanation as to where you're pitching and how to pitch. So fund 1, typically a VC will raise, let's say, a £10 million fund. And I'll walk you through a very, very typical standardized approach that many VCs go through. So I'm raising my fund 1. I'm a entrepreneur, turn VC, I don't have much experience raising. It's bloody difficult convincing a whole bunch of people to invest in me, and then I'll pick the best entrepreneurs. Why not invest directly? But that's a story for another day when you're looking at raising as a VC. So fundraising takes probably 2 to 3 years. Then they have the capital to deploy, and then the 2% management fee kicks in on that first part of the blue diagram for Fund 1. They have a 3 to 5 year investment timeline. If you're pitching to a VC and you're pitching at them during the fundraising stage, they're probably going to have a discussion with you. Why? Because they've got to convince their limited partners that A, they've got the deal flow, and B, actually they're out in the market talking to entrepreneurs and they know what they're doing. And so they absolutely need to be talking to you, because otherwise they won't have the deal flow. Why would the fund invest in them? And so you've got to be very aware that a lot of investors are out in the market without any capital to deploy. And it's only when they actually close their fund, unless there's a couple of exemptions, companies may do a first close, and then you might hear the words first close a lot of investors you speak to. That means they haven't yet launched their fund, but they've managed to close a small number of investors so they can then invest in you. That's one thing you might hear. The other thing you might hear from funds is a deal by deal. We invest deal by deal. Don't worry, you'll get your money. What that means is that it's not a guarantee that you'll get your investment. What that means is that they have to take your opportunity to their investors and then pitch you to them. It's very similar for them to pitch themselves within their investment committee, but it is pitching to an external party. So it certainly doesn't mean that they've got capital to deploy. So they've fundraised, they've got 3 to 5 years. Then you think about the next step. Do you get investment at year 3, or do you get investment at year 5? If you're getting investment at year 3, you've got a longer run rate. Your financial model can be longer. You've got more time to produce return for their business. If you're getting money at year 5, you've got a much shorter time frame. 2 years is a hell of a long time, and they may only be investing in the super high performing companies. And so your proposition needs to take into account that those investors are less likely to invest in companies, and they're probably more likely to invest in those massive fund returners. And so the way you position your business is really important to know where they are in that fund cycle. And this is one of the things that we spend quite a lot of time with entrepreneurs when we're speaking to them is, here's our list of 600 odd investors that are probably applicable. Here's 300 that hit your thesis that are relevant to your sectors. Here's 150 you've got capital to deploy now, and probably here's 50 that are, your sweet spot. And that analysis, that's what takes a lot of our time. As entrepreneurs, when you're going out for fundraising and you're going out on your own and you choose not to work with an advisor, our advice would be ask them this question. Where are you in your fund cycle? Do you have capital to deploy? Who are your limited partners? And what is your investment process? These are really critical questions for you to A, understand, show them that you understand what you're talking about, but B, get those answers to then position yourself in the best way possible. Then you've got the divestment strategy. So the years 5 to 7, you'll be happy to hear that typically investors don't collect their 2% management fee during this period. They normally tail it up to 1.5 and 1%. Therefore, they've got a lot more emphasis to raise their next fund. So during this period, they're looking to divest. They're not looking to invest. However, then Fund 2 comes in. So Fund 2 comes in. You can imagine if you're a VC, if you're an entrepreneur turned VC, right, and there's plenty of those around, you've raised your first fund, £10 million. Hooray! You've made 2% of that £10 million, and you're getting 20% of the upside. Super. Your next plan is Fund 2, and you tell yourself, wait a second, I'm getting 2% management fee on a 10 mil fund. Why not just double my fund to 20 mil? Because then I'll double my management fee. And that's exactly how many investors look at the world. They think, let's get a bigger fund. And you sell the dream to your limited partners by saying, we've got more companies, we want to invest at later stage, yada, yada, yada. But actually you're doubling your fund. And that's what a lot of funds do. They start with 10, then 20, then 50. And then they go back to their investors and go, actually, wait a second, we've invested in all these awesome seed companies. We want to follow on. We want to benefit from their growth. We don't want to just siphon off to, a Series B investor like a Highland Europe or a Frog Capital or an Ox Ventures. We want to be the ones that benefit from the upside. And then they raise a growth fund of maybe £100 million and then take a 2%. So you can see that there's a strategy within themselves. So the reason why that's applicable to you is that when they're finished deploying their first fund, typically they're raising their second. And so you might still be relevant to them, but you'll need to understand what stage they are in their second fund and in their third fund. So just understand which fund that you're positioning your business for, and understand where they are in that fund cycle. Because they might say, oh, sorry, we're fully committed and deployed in our fund one, and actually we're about to start making fund two investments, which is great because they'll be on the middle. If you go to the middle section, the first bit of blue here. Or they might say, we've just finished deploying capital in our first fund and we're raising our second. That is a flag for you. That is they haven't yet got capital. When are you going to close? They'll say 3 months. Double that, it'll probably be 6 months. Much like if I asked probably any one of you when you're looking to raise your next round of capital and you're probably in the midst of funding, you might say in 2 weeks. I would probably be professionally skeptical and say we'll probably get the money in a month, maybe a month and a half. Apply that same level of skepticism to those investors. So now, quickly, a quick background why you need to position yourself as the unicorn, which is always a question we get asked by founders. There's 2 different buckets. You can position yourself as a 5 to 10 times return, and you will benefit from the VCT and EIS funds. Those funds, obviously they look for unicorn businesses, but they're also quite happy with companies that can generate returns of 5 to 10 times. Why? Because you've got this additional tax benefit that they can leverage, which is awesome. If I invest in a company, I effectively get more than 50% of my investment back if they fail. Whereas the VCs don't have that tax efficient scheme because the investors are large institutions, and the government does not provide incentives for those large institutions into VC funds, unless, of course, they invest direct to VCs, which is a different topic. So this diagram shows you their return structure. 1 times return or less, 65% of the time. 1 to 2 times, 20%. 2 to 3, 10%. And the big one, the big tickets, the Ubers, the Facebooks of the world, 5% of the time. Which means on a typical fund with 10 portfolio companies, they're not going to even hit 3+ return in the law of averages. And in fact, the median return is low. The median return for VCs is 1.4 times over a 10-year period, which is a couple of percent. Of course, it's a top tier game, right? The median return for a startup, if I invest in a company, is probably low as well. But of course, there's these companies that become the unicorns. And so the reason why the investor is hunting for the unicorns is because if they don't hunt for the unicorns, you can see the diagrams. The majority of the companies do not provide their money back, or do not provide more than double their money back. If I've got a £100 million fund, I'm investing 10 over 5 companies as an example, and all of those, 4 of those companies don't return any money, that 10 million of capital, notwithstanding the follow-on investment, has to return all of my fund back. And in order for that to do that, if I'm investing in a company, I have to see the 20 times potential. And so when you're working through your financial model, and John talked you through an example, and you might remember that, year 2, year 3, you had this hockey stick effect. If you're not passionate and driven and ambitious enough to really hit those massive exits, then VC specifically isn't the route for you. If you're looking at 5 to 10 times exit and you're quite happy about that, then VCT and EIS is the route for you. If you're not sure, make up your mind, because you've got to make up your mind before you go out to investment. And that's, again, a large part of the work we do with entrepreneurs when we work with them, is actually figuring out how much they want to raise and what their ambitions are. Because it matters. It matters because, as I've described, investors need to find their fund returners, and it matters because investors have a very, very specific thesis that they look for. And so next time you get asked, why am I producing these documents? Why am I positioning myself at this unicorn level? This is why. Because they've got to prove that one of their 10 companies will be an absolute hit. And the only way of proving that is to invest in every single company that could be a hit, for VCs specifically. Things to think about when you're pitching then. when it comes to your ask. So for angels, you might need £1 million. You're going to do a couple of hires. You might hire a head of sales. You might hire an FD. You might build a team, and you might build you might spend stuff on your tech. You might do a couple of hires, and you can look at someone in the eye and you can say, "This is what I'm going to do. I'm going to gear up to a large Series A." It's a fairly run-of-the-mill proposition. For EIS funds, remember if you're within the process, there's a 3 to 5 year rule whereby an investor cannot exit before then. They need to hold that money within that period of time, and therefore, and also there's a cap on the amount they can invest. And so those people, they want an exit. They want an exit after 3 to 5 years. And so your strategy with those organizations, and it has to mirror your own internal strategy, is you want to be a break-even business in 18 months' time. You don't want to raise a 10 mil, 50 mil Series B. You might not want to be in unicorn in 2 years' time and raise a massive amount, because they're not going to be able to benefit. So you can see how the structure of your I guess your ambition has a direct impact to which funds you look to work with. And then a typical, mid-tier VC or top-tier VC, you need 3 million now to get to 2 mil revenue. When you get to 2 mil revenue, you'll raise a 5 mil B, you'll then raise a 20 mil C, and believe it or not, that Series A investor will be very happy. They'll see their valuations double, triple, double. They'll go back to their LPs, and when they're raising their fund 2, they'll get reinvested in this awesome company, and they've just increased their valuation by 6 times. We know how to pick our winners, and that's why they're looking for this very different ask and very different investor proposition. And as you may recall, John mentioned again this yesterday, the ask is something that often gets forgotten. You talk about your business, you talk about how awesome your product is, and then you don't come up with a question. You don't say, this is what we want to do, this is what we can provide. You've absolutely got to hit what the investor proposition is at the end of your presentation. Otherwise, it just goes cold. Otherwise, you just talked about your business and you haven't put a call to action. Now, we've talked about the use of funds. Now, the exit, where do you want to go? Do you want to be a unicorn? Do you want to be a £100 million, a £500 million exit? What are your exit routes? Are you speaking to those acquisition potentials? Have you got a way into Apple? Are you speaking to Facebook? Have they asked you whether you're open for an acquisition? All of these things trigger the interest of investors. The reason why some of this is relevant as well is it backs up your valuation. So you can say, look, a company maybe not in the US, because just divide everything by 10 in the US because the market is 10 times bigger and the valuation is 10 times bigger. But if you have a comparable in the UK, a company's raised, 5 million at 50 mil val, and they had this amount of revenue. You can use that analysis to then support your valuation discussion. I won't go into valuations today. That's not the topic of the workshop, but these are things to think about when you're speaking to investors. Right. The other thing to do when you're chatting to investors is to reference them and qualify them. It's not just about them qualifying you. It's also the other way around. Quantitative factors. These are a lot of the factors I've talked about today. Their fund size, their thesis, what they look for, where they are in their deployment cycle. Who are they? Are they exited entrepreneurs, or simply are they finance professionals that have joined the VC industry because they like the sound of investing in companies? These things dictate how you position your business. And then you have qualitative factors. Now, qualitative factors are those where companies and funds, often it's not as clear to understand, but often it's the ones where it's the softer things. It's what value add are they providing? What is the background of the team? What is their thesis? It's things like have they got a particular expertise in the sector? It's how well do you get on with them? It's their culture. It's all things that you can probably find out as you're speaking to them and as you're negotiating a term sheet with them. Right. Then we talk about the investment process, and I think this is the one more slide. So the investment process typically looks like this. First of all, you connect. You might pitch to them. You might get an email introduction. There might be a number of different ways. As an example, the way that we work with companies and entrepreneurs and the way we introduce them to investors is a number of different ways. We have a newsletter that goes out to 500 to 600 investors, and we normally showcase the companies there. We introduce them by email. We might do a webinar, an event where we invite those relevant investors into a link like this where companies pitching. You might be sending a cold email to a fund. You might have a warm introduction. Whatever way you connect with them. Then you'll probably share a deck. You'll share your pitch deck. Hopefully you'll have covered the things we talked about yesterday on what to include. You'll have your first stage meeting. It'll be nice. Tell me about your business, work on stuff. Remember to save a good 10 to 20 minutes at the end of the presentation to discuss your ask and your value proposition, and also your investor proposition. Then you'll share your other docs. We ran through them yesterday. And then you'll have your second stage meeting, and then the process kind of divides into two. Some VCs do a quick IC, quick investment committee, and then you'll have a quick yes or no. Others might provide your term sheet, and they'll say we'll have the IC later, and we'll go through all the different terms in the term sheet tomorrow. But those are the two different avenues, and then as you carry on going through those two avenues, you might then get diligenced, and hopefully then you'll bring your lawyers involved. I'd recommend to bring your lawyers as soon as there's a hint of a term sheet. And then you'll go through diligence. That might take anything from 3 weeks to 3 months, and then you'll get money in the bank. And the way that the money in the bank occurs is that there might be some tranche funding and all sorts of different mechanisms in there, which we'll cover tomorrow. Great. So concluding remarks on the generally on engaging with investors, and feel free to ask questions on the specifically on Livestorm. There's a section on the right which I think you can ping questions over. So consider the incentives and the way that funds are structured and the way that funds are run. Consider the things that we talked about on their strategy, the way they're structured, the way they operate, the way they make money. All of these things really helps build empathy and really supports with the relationship you're starting from scratch. Think about the role of different team members. So, if you're approached by an associate on LinkedIn who's sending a cold email, build a relationship with them. If you're speaking to an investment manager, use them as a gateway into the organization. The way decisions are made are through an investment committee. You remember, for VCs, it's not their money. They've got to persuade a whole bunch of different people. And all the documents, all those open-ended and long questions that you have to ask and answer for them, they're just collating. And they're just going back to their own investment committee and then pitching to them. If you're speaking to a billionaire or a millionaire directly, they don't have another person to go back to. You'll tell them how it is, and they'll say yes or no. If you can find those, great. And we always, it's always great if you can find a family office like that. But you've got to be prepared to go through the typical process, because many entrepreneurs aren't lucky enough to be able to find a family office. Ask plenty of questions. Just make sure that when you're going through and you're engaging investors, you ask those questions I suggested. Where are they in the fund cycle, and what's their investment thesis, and tell us about your entrepreneurs. Tell us about your own journey. And remember, if they're raising a first-time fund, they are absolutely entrepreneurs. Raising a first-time fund or even a second-time fund is very, very difficult. It's 2 years on no salary, because the 2% doesn't kick in until you do a first close, which is another reason why often they do a first close. They're running a team, they're building a team, they're running a business, everything that you do, they're doing. So if you're speaking to an emerging fund manager, they absolutely have an entrepreneur experience because they've raised their own fund. If it's a second or third or fourth time fund and they've hired people into the business, then maybe you can prod them a bit more. Have you built a business? Have you exited the business? But just bear in mind, if it's a first time fund, they've gone through, the sleepless nights, the missed birthdays, all those things that you're all used to, they've gone through as well. Do your diligence, ask them questions on what they look for, ask them questions on the criteria that they look for, and actually reference them. Speak to their portfolio companies. You'll see that tomorrow when we talk through term sheets, one of the things within the way that we look at term sheets, we split into 5 different buckets, and one of those buckets is typically the first page, and the first page is an investor love letter. It's a love letter from the investor to you. You are awesome. We've got companies who are similar to you. This is what we've done, and they'll pitch to you. None of it will be legally binding, of course, but they'll pitch to you how awesome they are. Take the opportunity to do your diligence, reference those companies they've spoken to, and diligence them. Actually, and then there's an organisation actually live now that just launched called Landscape VC. We chat with them a couple of weeks ago, and they have created a open sourced platform to diligence investors, which is great. It means that you can go in and you can see that what other founders are saying about investors, and then lastly and most importantly, empathize with them, build a relationship, and take and leverage hopefully what some of the things you've learned today, some of the things that you've been reminded about today, and use that to your advantage. Use the fact that they've got it raised for themselves to your advantage. Use the fact that you know how painful it is for them to pitch their own investment committee, and you've got to find someone that can wave the flag for you. Great. So a couple of questions. One of the questions is, what are the typical revenue multiples for different types of firms, managed services, SaaS, B2B marketplaces? Valuations is a whole separate couple of our topics, but of course, happy to answer that. The typical revenue multiples at the moment for B2B recurring services is probably anything from 5 to 8, 10 times revenue. The higher number is typically for those organizations that have high revenue growth, because the multiple, remember, is a approximation of the discounted cash flow analysis, and that approximation typically is your revenue multiple. So if you're growing more quickly, then you can probably use your forward-looking revenue rather than your backward-looking revenue and reach that higher target. For managed services and for consulting services, if it's one-off, it's anything from 1 to 3 times. Reason being, if you're an investor, you've got a business and you're investing, into a company, and they've got a sale, and each year they've got to find a new customer and make a new sale. That's not recurring, and they treat that as 1 to 3 times. And then for marketplaces, it massively depends on the growth, where you are, what sector, but typically it'll be a mix of the two. Great. So I think, let me check. The next session in a minute will be a panel. I will be speaking with Richard from Brightlight and Nick from Octopus. Before we jump there, a couple of things on tomorrow. There's a reminder. The wonderful world of term sheets and how to interpret them. I'll be running 45 minutes or so on all the key terms and what they mean in very plain English. We've got Anthony Rose, CEO of C Legals, coming in. Alex will be doing a panel with them, as will Olivia. Great, I can just see Nick's just joined. Hey, Nick, we're just waiting for Richard.
Hey, how you doing, Jonathan?
Very well. You're live on with a bunch of people listening to the webinar. Welcome.
Cool. Thank you for having me.
Whilst Richard joins, do you want to do an introduction? I guess a personal intro and maybe an introduction to the fund?
Yes, sure. So quick, Octopus is one of the larger, I guess, and more active European VCs. So we're about 10 years old. We do primarily seed and Series A investing. The seed fund we had a little celebration this year because it crossed $1 billion in size, which is exciting. And then we also have a growth fund as well, which lets us back, I guess, sort of the winners of the seed fund. In terms of our focus area, we are agnostic by trade, but we have, I guess, over the last few years, specialized into different focus areas. This is deep tech, so that's anything that's almost industry 4.0. So think drones, VR, AR, semiconductors, all of that fun stuff. Then we have Future of Health, which does a lot of digital therapeutics, wellness. We've done investments into like all plants, all the way to sort of gene editing platforms. So quite a mixed bag. And then the team I sit on, which is the future of money team. So that does fintech. So I think payments, insurance, crypto, capital markets, credit and lending. And we've looked in particular at payments and insurance, I guess, and some capital markets plays over the last few years. In terms of just the team, so quite a big team now. We've got an office in New York as well, which we just use pretty much primarily for helping our founders make that transition to the States. Over half of our portfolio companies are now active in America, so it made sense to open that office up. And we've got venture partners around the world who can help our businesses, I guess, grow.
Awesome, thanks, Nick. And what about personal intro? How did you get that?
Yeah, me. So I come from entrepreneurial background, so I tried and failed, I guess, to get a couple startups off the ground. I did an NFC business in New York, which we were putting NFC tags into clothing labels to try and make like a connected store. This is like when NFC was a hot new thing, and then and ended up licensing that business out to a logistics company. And then I came to London, started a completely different business in SaaS that we were putting sort of men's grooming treatments on a platform. Grew that quite rapidly for 2 years, and then the supply side broke. Learned a lot of lessons out of that. Joined Octopus, and now I sit on a few boards and look a lot at, as I mentioned, the credit and lending and payments businesses.
Bonjour.
Hey, Richard, you're live on webinar. Perfect timing. Thanks for joining.
Thank you. That's a pleasure. I was on time, but wasn't able to get shit working, unfortunately.
Yeah, all right.
I could hear you and I could see you, but yeah, all good.
Cool. Do you want to introduce yourself, maybe bright light, and also a personal intro?
Sure. So my name is Richard Haynes. I'm the founder and CEO of Brightlight. And what we're doing is delivering speed of thought analytics. The way we're doing that is using graphics processor units federated together to process large amounts of data and provide a user experience, a sub-second user experience on billions of rows of data. We closed some funding with Amadeus and Finch earlier this year, 3.2 million. 1.4 million has already gone into the company. We've got about 4 or 5 years of research as well, and a lot of traction in the telco space. So there's about 40 operators across the world who are using our software to run analytics on their network operations, including big customers like Verizon. We've also got Vodafone, EE, 3, Deutsche Telekom. There's a bunch I could go through. There's 40 of them, but all very well-known operators.
Great. And do you want to tell us about a recent close, your recent Series A?
Sure. So that started all last year. So the long story there is we went live with Verizon last year at around February time. Started generating decent amounts of revenue. Ended up about 1 million ARR end of 2019. We've got a fairly big engineering operation in Warsaw, very cost effective, but very, very efficient. And that was around about parity, so we are sustainable, but we didn't have any money for growth. I know this is common, right? So we realized that we needed to raise funding. Went through a long process, initiated a bunch of, joined with a bunch of accelerators. The most important one was the PwC Raise program, which we did last year with you guys, Jonathan. Very successful for us. Ended up pitching to around, I think it was more than 60 VCs in the London area. We got, I think, 52 follow-up conversations, which was great. Burned up a lot of leather pre-COVID days, visiting everybody in London. And then December, we got our term sheets. January, we've got another one. 2 fantastic investors in Amadeus and Finch. Amadeus, I think, is pretty well known. Boutique specialist investor in deep tech. Long history, successful. Great partner for us because they understand deep tech and they understand some of the challenges and requirements around that. Finch is a bit more modern, more recent, I should say, but a very similar kind of thesis. And they're based, their head office is actually in Amsterdam, but they've got a London office. So put them together, closed the round sort of as the crisis was just kicking off. I'm not sure what the audience is, so but it was certainly squeaky bum time. I think we all know what that means, right? But fantastic investors, and I think a great credit to ourselves and to them that we closed basically on time with the terms that were agreed in December and January. And I think that just shows that they're a great bunch that take a long-term view on things, and also, see us as a good investment. So that's been great. That all closed, landed the money in April, early April. And I'm sure there's a big audience here, so I'm sure they will have this experience, I hope. But I've never seen 3 million in a bank account that I could access. Checked the plane tickets. Everybody was cancelled. There's no trips to Bermuda, unfortunately. But no, it's been great. We've been spending the money, hiring. That's got its own challenges, but we've almost doubled the team. So we now got 25 people across Poland and the UK. When not so long ago it was only 16 or 17. So that's what we've been going through at the moment.
Great, thank you. That was super great to hear. Right, when you guys closed months ago. Nick, do you want to tell us a bit about what you look for in entrepreneurs and I guess your sweet spot?
Yeah, totally. Our sweet spot is predominantly Series A deals, so I think 4 to 5 million checks. And at that point, there's still not years of information and financial traction that you can pass through. So it still is a bet on the founding team above everything else.
Yeah.
As I mentioned, with the fund being over $1 billion, we look for really, really large opportunities that can almost, grow businesses north of that number, right? Because even a business that sells for, 100 million, probably great result for the founders. Everyone's very happy, but doesn't necessarily do that much once your fund hits a certain size. So we're looking primarily for great teams and massive opportunities within those 3 verticals that I mentioned we look at. Nice.
And can you, one of the things I was talking about earlier is around fund size and then for figuring out your sweet spot. You mentioned 1 billion. Can you reconcile that versus the kind of your sweet spot for the benefit of the audience? Maybe mentioning some of the other funds you've got going on.
Yeah, it's an interesting one. So I think investing in seed, so I think that the smaller check size, 1 to 2 million, you have to do a fair few investments to make that investment strategy work. So you have to be a little bit more quantity rather than high conviction. As I mentioned with Octopus, we go quite deep into the businesses. So we have a hiring team, we have that New York office, we have venture partners, and it's quite, the support we offer the businesses is fantastic. But for us to do that at a seed level, for example, would be just mayhem because there'd be so many different businesses. So that's why the sweet spot being 4 to 5 million Series A makes a lot of sense. Recently, we have been going a little larger with those checks. I think rounds in general are getting bigger and bigger, so we're having to adapt to that. But we, just having that opportunity to see a little bit of traction in the market, if it's a B2C business, being able to witness that customer delight is quite valuable. So us waiting rounds and then getting in at the Series A is probably still the best setup for us. That being said, though, we've done a bunch of seed deals, and if we have an outstanding team, we don't need much more than that. So it does chop and change.
Got it. Richard, a bit of advice to entrepreneurs looking to follow a similar journey that you've been on. What kind of top 3 tips would you give them in terms of, prep, engaging, and other ideas you might have?
Top 3 ideas. With regards to execution or raising money or
raising money.
That's okay. So that's a great question. Clearly, so I think understanding the value proposition really well is the first part, and being able to articulate that. I think that was the biggest journey I had. I'm a tech founder. I love tech. And we use GPUs, and I could spend all day on GPUs talking about them. But it's a very small audience who would find that interesting. So I really had to reposition that. And I think, even while we were on the PwC Raise program with you guys, Jonathan. That was one of the big things that was important for us. How do you present that? So it's really understanding what that means, what your tech means in the marketplace. Sometimes that's quite difficult. The other thing is to understand, again, it's a bit difficult from a tech founder's perspective, so you've got to really sit in the investor's chair and understand their point of view, really have great empathy for the people who you want to engage with. And so there's a couple of things that can help you out there. It's just understanding the audience. But the investor community is quite a broad community. There's specialists within various areas, both regards to how they source deal flow, where they get their money from, so their LLPs and the pitch that they're presenting, and what they're looking for, and what their returns are. So, having a bit of research to understand that space, working out who are the right people to pitch to, engaging with them in the way that they want to be engaged with, and then making sure that the pitch presents a way that they can consume the company and the proposition, and also how they're going to make money. I mean, ultimately, without having to join too many dots, in 5 minutes, you need to be able to say how they, in a clear way, how they're going to make their money. I think sometimes that gets lost a little bit. We had a lot of support. I had a lot of support in doing that. And when you do get it right, then a lot of people want to speak to you. So that's what I think. That's the most important part there. It does require a lot of research. So you've got to go and find the people. And I think these kinds of networks and working with you, Jonathan, without pitching you too much, is really beneficial, because you guys have got that perspective, the relationships, and all those kinds of things.
Yeah, and just to add to that, I think there's no dancing around it. It is a numbers game. It's a conversion. It's almost like it's a funnel, right? And like Richard said, he found a way to hack almost 52 introductions to VCs, and he walked away with 2 term sheets. And that's actually really good from a conversion standpoint. Secret Escapes, which is one of our highest performing companies, they have to meet 40 investors to get 1 term sheet. And I think the single biggest mistake is not properly just realizing you need to speak to everyone if you're going to get lucky, and mapping out that market. And I guess from Mount side, that's something that you could definitely help with.
And I guess, Nick, what a company that doesn't know you, what do you think is the best way of engaging you specifically? What's the
it's a good question. So frustratingly so, it's still warm intros which are the best for VCs, right? But what that does lead is that certain networks get overfunded and certain networks get underfunded. But if you can find a portfolio company and or someone who's working, a venture partner of that fund, and get a warm intro into the fund, it does have higher conversion rates to new meetings. That being said, if you apply on our website, we do look at everything. It's just, that's a different pool that you're being viewed into. So warm intros is probably the best, or do what Richard did and find a way to get in front of a lot of eyes, right? Maybe a pitching panel or something like that.
Yeah, so if I could just support you there a little bit, Nick. I started by saying we realized at the start of 2019 that we needed to close funding. It was a year-long program that we could set ourselves on. We knew that we wanted to close around early this year, so we prepared. We spent a year on it. PwC was the last program, but I went through 3 accelerators before that. Momentum, London. There was a Catalyst Accelerator in the University of Southampton. There's PwC Scale as well, which is not quite the pitching part. So absolutely, getting in front of and doing these accelerators is a great way to get in front of a lot of people at the same time and have that support with the pitching, if you don't have an established network.
Exactly. And Nick, one of the things, we had Devon from Sale Partner, Capital Sale, yesterday, and I was just sending her a message this morning. She had a flow of LinkedIn requests after the session yesterday. What's the best way of reaching you? Is it through LinkedIn? Is it warm intros, or do you?
Yeah, my email's on the website, so probably just by email. I've already seen that. I've got a bunch of LinkedIn's, but LinkedIn's quite a noisy space. And a lot of people will just avoid it because it's just another channel to have to monitor. So, you should be able to find our emails either through the website or just on those little hacker tools they have online. I think it's better to approach by email.
Cool. Enjoy the next 24 hours then.
Yeah.
And Richard, any thoughts on a mistake you made, or something that you thought could have gone a bit better? Maybe either on the execution side of the business, or generally on the fundraise.
Should have asked for more. Seriously, that's such a good question. I don't know. There's nothing that comes to mind as a regret or something that I feel, oh man, that got away, or that could have been done better. And that I don't think is necessarily because I'm arrogant. It might be a frame of mind. I think everything is beneficial. There's always information to be had. So, we did have 50 conversations, over 50, and only 2 term sheets. Now, in some lights, that might be considered a bit of a failure because there's 48 people who didn't want to continue the conversation. But actually, those were 43, 48, 40, whatever the maths is. Anyway, the important thing is there's always an opportunity to learn. And as long as one's taking that information and learning, and you do a little bit of debrief afterwards, why did that conversation go well? What were the hooks that they were responding to? What were the bits that we think might have turned them off? And most often, actually, investors will tell you flat out, too early, too late, not the right sector, not the right whatever, and so on. So it is almost like qualifying when you're looking for customers, because the investors will tell you it's not black magic. It's they've got a very specific thing they're looking for, and you need to identify what it is, and you just align them. And when they align, it all works. Yeah. So yeah, I don't think there were any major lessons or hiccups. The whole process of the lesson, you're always improving and trying to work out how to do it better.
Yeah. One thing I would add is quite a neat trick, and this is potentially when you're raising your next round, so maybe your Series A, is tiering your investors. So if you take your ideal investors and then your sort of people who may be a little bit out of scope for you, practicing your pitch and your message and your ask, right, with those investors, so that when you go and speak to your tier 1 people who are perfect investors for you, you've actually practiced it and you've got a bit of feedback. All too often I see startups go straight for the best investors first, and then they get really helpful feedback, but by that time it's too late, right? So definitely practice with the sort of more out of scope VCs.
Yeah, I think Richard, regarding your comment, I think it's also down to your personality, right? You're kind of you get as much as you give, and I think you're always super engaged, especially when we work together. Nick, the question for you: if you can try and reply with being as specific as you possibly can,
yeah,
and using quantitative things if you can. If you could describe your ideal profile of a startup, so rather than saying great team, great product, big market, if you've got more specifics to say, hopefully out of all the people on today, there might be 1 or 2 that hit that criteria.
Okay, that's a tough one because for different sectors, it's different. But for the specific areas is repeatable revenue. Right, so we always lean on recurring revenue, and times like COVID, right, have really shown the benefits of having repeatable revenue. Some of our transaction businesses, especially those in the travel space, have gone pretty much to zero overnight, and so we lean on repeatable revenue. We love high NPS scores for our consumer businesses, so anything above 70 NPS, come talk to us. We think that's a proxy for repeat and sticky users. So those are some key ones that we look at from the metric side. There's a huge growth story. All too often, businesses that probably aren't right for VC. They're growing sub 100% a year in their very early stages, and there are investors for those businesses, but the returns that we're looking to generate, right, do require, especially in your early years, for I'd say above 100% growth, at least for the first 2-3 years of actually launching your product. I know oftentimes it would take a while to get your product to market. And we also look at Glassdoor, right? So if you've got really negative Glassdoor scores about the CEO or about the management team, we'll take that into account and we'll ask questions about that. We've ignored that in the past, and that's come to bite us in the arse, because everyone's wearing their church outfits when we're meeting them for investing, right? And it's after that investment when sort of the walls come down. So those are some actual like fundamental areas that we will look at with businesses.
Thank you. Yeah, specific enough. Thanks, Nick.
Yeah.
Thanks for the metrics as well. Great. So if anyone's approaching Nick on email, you can reference that those metrics you use, and I'm sure.
Yeah, please do.
Much more likely to reply if you can hit some of those, right?
Yeah.
Richard, did you do anything to celebrate? You talked about the 3 mil in your bank. Did you have time to do anything?
I hope you did.
I think we opened a bottle of champagne or something like that. But that's a great story, actually. Normally you would have an opportunity to go to a bar and celebrate it with the team, but we didn't because of COVID. But it's this really, really long journey. It's absolutely a marathon. It's not a sprint. And you're constantly working towards it. It occupies so much time. And it is a little bit of an anticlimax. I did sort of suffer a little bit from sort of anticlimax syndrome, if there's such a thing, for a couple of weeks afterwards. But you're looking at the paperwork gets done, and then it goes around, and everybody's signed, and then that's it. You kind of get an email that's signed, and then you're watching the bank account. Then suddenly there's a chunk of money, and you kind of expect at some point somebody's going to come through the door with a brass band, and there's going to be doves and a voice from above, congratulations. It doesn't, it's just nothing. It's just suddenly there. So it was quite a surreal feeling. I mean, that's definitely something that I recognized. But you start to realize it, and we check the bank account every day because we were wondering if we were going to make it through the next couple of months, right? So you're so used to it and seeing it that you become familiar, and then you start spending it, and suddenly the preoccupation with closing the round and checking the bank account turns into another one where you hiring and interviewing every day, and trying to onboard people, and suddenly your team's 25 people that you're trying to communicate the vision and the culture, and some people start heading off. So it changes, and I suppose the next thing we'll be aiming for is a certain revenue figure, or closing more money, or closing a big deal. We've got a couple of big deals in the pipeline now, which could be absolutely transformational. Double or triple our revenues in an instance, which is fantastic if you think we're already on a million ARR. So it's an absolute roller coaster. I think lots of people on this call will recognize that it's that cartoon of a guy on a line, right? And it's just day to day great things happening, and then maybe not great things happening, but yeah.
Cool, thanks, Rich. I'm glad that you found one way to celebrate, and maybe once we're back out, everyone will be celebrating properly. We actually launched our business during COVID, so it's been an interesting time for us. We had our first face-to-face meeting with the partners Monday in London after launching. It was an interesting experience.
We're going to. It'll be announced. Sorry, Jonathan. I know you're talking over you, but the way COVID works out, we've got a great candidate to join our board. We'll hopefully be announcing that. Everything's sort of in place. We just need to get it officially signed off. But we met up in Hyde Park, and all the restaurants in Hyde Park are basically closed. So we were having basically a chairman interview on the grass under a tree in Hyde Park. So it's all very different, but that'll definitely be a fireside story to tell in years to come.
I'm sure there will be. We've had a bunch of questions come in as expected. Nick, one for you on I'm sure you always get asked this. Revenue multiples, always a sensitive topic. Can you give us a rough range for recurring B2B?
Yeah, definitely. So at the early stage, it's not really as much about multiples, right? Because if you look at like even payments businesses who traded at some of the highest multiples. All the companies that we're doing in seed and Series A, we're giving them a higher multiple than that, right? So it's kind of a more of a product of how much you're raising. So if you want to go out and raise 5 million, right, you should expect 20% dilution for that round, right? And then your valuation is derived off of the quantum that you're going for. We don't really use the multiples at the seed and Series A stage, to be honest.
Okay, that's good to know. Another question on KPIs. What do investors track once the funding's been?
Yeah.
This question for you, Nick and Richard, maybe on the funding side.
Yeah, and I'm sure Richard, being on the other side of the table, has had these conversations as well with his VCs. But for us, when we make that first investment, we sit around a table and we say, okay, where do we want to be for your next round of funding, right? And these are sort of the key KPIs, and this will either be a growth, unit economics, revenue, even team, or if it's like a drug discovery app, like achieving a certain clinical trial. So you kind of agree those metrics with your VC, and then you track those as it goes on. Generally, I always see revenue being one of them, and I see growth, and I see unit economics, because these are the sort of stories that for a Series B investment you need to have in line to attract top tier investors. But oftentimes there'll be other interesting stuff in there. I'm sure Richard, you've done this exercise with your investors.
Yeah, absolutely. So exactly how you described. It's all framed around the next round of funding, Series B. When's it going to happen? Speaking to the investors, what do they think they would want to see if they were investors? So it's definitely framed around that. And so you agree some high-level objectives. Revenue is a big one for us. Absolutely, revenue growth. Also diversifying our customer base within specific verticals and across verticals. So if we achieve those, we feel that we'll be in a good place to raise successfully. But then to achieve those, that's the next layer down. There's hiring, there's marketing, there's a bit of marketing discovery. So how much time do we give ourselves? How do we do it? How do we empower the people to do that? The company is going to be a bigger company than it is now. It really is. So the whole way you manage it and structure it and organize it needs to fundamentally change. And there's a lot of focus on raw metrics on revenue or marketing, but actually to deliver those, you've got people, and those people need to know what they're doing, be accountable, responsible, motivated. So how do you achieve that, and how do you get that information flow from the exec down to the people who are at the coalface doing stuff and back again, because you start to get those lines of communication, whereas before I'd have a very tangible, tactile almost, if that's the right word, conversation with people. As the team gets bigger, that goes away. You've got new people and you've got a lot more work on. So all those joined up, there's marketing, you've got your very specific marketing measures, but we call it the big triangle, and we've got a conversation around how that all works and what that means. But the big triangle is, you're focusing towards one goal. And how do you, and the strap line within that for us is, how do you get people to do the right thing at the right time? And that's all about giving the right information, making sure they're skilled, motivated, all that kind of stuff. And information is a two-dimensional or a two-way street. So it's not just exec telling people at the coalface need to be able to tell the exec with clarity what their experiences are and what's working and what's not. And so the big triangle is all about that kind of thing. So, I know you asked about metrics, and ultimately there's a deliverable, but it's the whole thing needs to be aligned towards achieving that.
I quite like that big triangle, Richard. I might have to borrow that one from you.
It's Gary Smith's our COO. So I sort of said, we need to, how do we do this? And he's like, right, okay, it's the big triangle, Richard. And we had a meeting the next day, the big triangle. So yeah.
No, thanks, Richard. That was very comprehensive. Nick, final question to you. I think we've got a minute or so left. We talked yesterday about a recent deal you closed, remote. Can you talk us through a bit about that?
Yeah, so we weren't sure how we were going to do that, because, as I mentioned, this is investing in people, right? And you really got to get to know the person, and that's kind of harder over Zoom. But this was a investment it wasn't on the, it was on the Future of Health team. And as you can imagine, right, health has become, their pipeline has actually expanded during this case. I think everyone, it's almost like the Bitcoin craze, you know, everyone was sort of a blockchain company solving X. Now everyone's a digital health company solving something to do with coronavirus. So it made a bit more sense, but you know, it took a lot. It took even more meetings, even more virtual one-to-one Zoom meetings to get that deal over the line. More reference checks, just because you weren't able to get to know the person. That being said, now, because the parks are open, and I think actually, you know, a lot of pubs are open now, you can actually go and meet someone like Richard did under a sycamore tree or something like that. And that's, so we've made a few new hires at Octopus, and we've gone on walks with them too. So while it was cool to think that we could make a fully virtual investment, and we did do that in that circumstance, I'd push any founders now to just get their VC to, or someone they're speaking to for funding, just to go on a walk with them. I think you make such a stronger personal connection. But we did do it. It wasn't perfect.
Give us a couple of numbers. You mentioned references and meetings. We're talking,
Yeah.
we're talking 5, 20?
Probably more around, so I reckon it was about 6 meetings with Octopus, and normally it's around 3 or 4. So we did probably twice as many. And then references, a normal amount of references. It was more just the increase of internal Octopus meetings that we did to get around that.
Okay, awesome. Well, it was awesome to have you both. Thanks, Nick, and thanks, Richard, for your time. We were a couple of minutes over, but I think it's been super insightful. Guys, a reminder, tomorrow we're talking about term sheets, and we have Anthony, CEO of Seed Legals, Alex, a partner at Mount Side Ventures, and also Olivia from FinTech Alliance. But for the time being, it was great to have you both. Thanks, Nick, and thanks, Richard. Enjoy the rest of your days.
No problem. Thanks, Jonathan. Good to meet you, Nick.
Yeah, good speech to you, Richard.
Everybody.
Thanks, everyone, for joining. Bye.
Okay, bye now.